Most of the investors invest in fixed deposit, postal savings schemes and senior citizen savings schemes. There are mainly two reasons why people invest in these kind of instruments. Number one, safety of their principal amount of investment, and secondly, guaranteed rate of return. Generally, FDs are giving 6% to 8% annualized returns to their investors. But there are two basic problems in these kind of instruments. One is lower rate of return, and secondly, higher rate of income tax. Because on fixed deposits, we have to pay income tax at slab rates. So if you are falling under 30% tax bracket, that is, if your income is above 10 lakh of rupees, your tax rate is 30% and you have to pay tax at the rate of 30% on FD interest. Today, we are going to discuss about how we can earn more returns by investing into government bonds and also how we can save taxes on that. Hello, I am Amit Shah. Today, I am going to discuss about three major points in government bonds investments. Number one, what are government bonds? Number two, why this is the right time to invest in these kind of instruments? And number three, how we can save taxes by investing in such instruments. Let's start. Central government normally issues bonds to the public and collect money and pay interest on that. Therefore, the bondholder gets interest from Government of India, and by default, it is kind of most safest kind of investments for unit holders or bond holders. Number two, why this is right time to invest in government bonds. You can see on the screen right now bond yields are around 7.35% annually for a long-term bond of 9 years plus. And right now we are almost at the peak of interest rates, because in last 1 year RBI has gradually increased its interest rates. Now what is going to happen in future? So these rates will be stabilized and again will start falling. And there is a very special feature of bonds, that is, when interest rates are falling, our yields gets increased. It is a bit difficult to understand, but this is a very unique feature and we should take use of it. So if we invest right now in long-term government bonds, we will get firstly 7% plus annualized interest, and over and above that, when again interest rates start falling, we will get capital appreciation, and according to me, we can easily earn between 9 to 10% annualized returns in next 2 to 3 years time period. Our third point of discussion is how we can save taxes on this. Instead of investing directly in government bonds, if we can invest through mutual funds which invest in government bonds, those are termed as gilt funds. Now, the interest earned on bond is considered as our regular income and taxed at slab rate. However, if we are investing in gilt funds, the taxation is as per capital gain tax, and it is termed as long-term capital gain when we invest for 3 years plus time horizon. And the tax rate for long-term capital gain is 20%, and also we get indexation benefit for that. So according to me, the effective tax rate will be around 8 to 12% for long-term capital gain invested in gilt funds. So now we have understood that by investing in government bonds in current scenario, we can earn higher returns, that is around 9 to 10% returns over next 3 years, and also we can save good amount of tax. So according to me, I will suggest to all the investors who prefer to invest in such kind of guaranteed interest bearing instruments, instead of keeping funds in FDs or these kind of instruments, it is better to switch to gilt funds in current scenario to get higher returns as well as to save tax. Thank you.